Lynn.
Hi,
Thanks for coming.
Thanks for having me.
Get right to it. A couple of bankers in the audience, I think. So the question that they are asking, and a lot of the press too, IPOs incredibly slow. That is your business.
Yeah.
When does this start to thaw?
Yeah, it's one of our businesses. We saw the green shoots of the IPO markets reopening in Q2 of this year. Brought a bunch of tremendous companies to market, Kenvue, Savers, Kava. And we saw that continue through Q3 with some of the more tech names coming to market. We just brought Klaviyo, for example, to market. And we're in the process of gearing up for a variety of different deals to come to market in Q4. It's a soft reopening. All of these deals have different structures. All of these deals are different businesses. All of these deals have different revenue profiles and are in different states. And you see some performing better than others. But you see some stocks in the market that have been in the market forever performing better than others in this environment too. So the IPO markets are showing exactly what the equity markets are showing. There are periods when it's darn volatile.
Sure, though I think Instacart is back below its IPO price. Klaviyo slightly above it, but have given back all those
Klaviyo has been the best performing
yes.
of those three. For a while, they've been probably about 20% above their IPO price. But it's important to look at their valuation too. Their valuation, their last round in the private market was $9.5 billion. Their valuation when they tapped the public markets was $9.2 billion. So the market had already rewarded them to a certain extent, saying, yeah, this was the right valuation that they had in the last private round.
But companies looking at these IPOs and seeing price pop and then immediately tank, let's say, yeesh, the water doesn't seem very warm.
For companies who have durable business models, who have good recurring growth rates, who are growth but also disciplined, particularly like in the case of Klaviyo, where they're revenue positive, they're not growth at all cost. The markets are open. The markets are able to reward those types of companies. And there is investor appetite for the right companies. We're gearing up for a variety of companies to come in even the next week or so. Birkenstock just flipped public. So we're incredibly excited about the future. But you're not going to see an opening of the floodgates. I've said since we saw the soft reopening start in Q2, you're not going to see the floodgates reopen probably till 24. There's got to be a few months of sustained deals getting done at the right price, and then the couple of weeks after a company is public, having a good result, staying above that IPO price.
Right. Kind of in the last gasps, I suppose, of the SPAC boom.
Yeah.
High level, did that do any good for anyone?
So the misnomer in the markets is that SPACs are this new thing. Having 600 SPACs in the market all at one time is a new thing, but SPACs have been around for 20 plus years, and they have been a way that companies have gone public for those 20 plus years. What you didn't have, though, were 600 all go at the same time, all with the same expiration date, all with a flood to find a deal, sometimes taking companies public who weren't yet ready to go public. It all comes back to, is a company ready to be a public company? Are they clear on their strategy? Are they clear on their profitability? Are they disciplined on their expenses? And are they telling a differentiated story that an investor would be interested in?
Let me ask though, exchanges serve as some gatekeeping, right?
Yeah.
You can delist a stock if it's too thin traded. You require audited financials. Understanding that investor protection is not your job, it is explicitly someone else's job, the SEC. I don't know. Why was there not more friction in these companies, to your point, that we're not ready to be public?
Yeah, we have a different level of listing standards. It's actually a responsibility that we take really seriously. It's our job as NYSE to be the gold standard of regulatory oversight, of rulemakings. What that means is many companies that have gone public over the last couple of years didn't qualify for us. So it's one of those things where if a company's ready, if it meets our very rigorous listing standards, we're happy to welcome them into our community.
Okay.
But we do have a differentiated rule book.
Okay, but you don't think that the exchanges should have, been sort of the arbiter of this company is ready? Or you think the market can do that?
I think the market marks I think the US equity markets are the most liquid in the world. I think that their ability to value and to reward innovation is unparalleled. I think that a company who demonstrates that innovation and does so in a way that piques investors' interest, I think the public markets are the best way to reward that. And that leads to additional innovations coming to market. If I look at various sectors that have rewarded innovation historically, technology, biotech, those areas, if those companies didn't tap the public markets, would we have some of the advances we have in this society? I don't think we would.
Public markets are the new private markets.
Yeah.
You have a computer science degree,
I do.
Your career at IBM. Trying to stay away from the hype of AI. I wonder if maybe you can explain sort of how you think it'll impact markets, but maybe things that are already happening and have been, but didn't have the AI glow around them. Things that are sort of near term, you think really game changing, and then maybe throw a moonshot out there.
Yeah, so it was funny, I was talking to someone about AI earlier today, and we're both fascinated that this year is the year we're all going to talk about AI, because both of us have been working in AI for more than a decade. We've actually had a product in market which is around adding efficiency to some of our less transparent markets, specifically our energy, some of our more bespoke energy products. We've had that in market for 10 years now. But this year, we've seen an incredible adoption of that product. What that product does is it knows if I'm talking to you about these lights, or if I'm talking to you about price discovery in an energy options market or a utility options market, whatever the case may be. If it detects that we're negotiating a trade, it'll pop in fair value, what we see as fair value for that trade, and it'll also allow you to submit that trade to our exchanges and clearinghouses. The activity generated through that platform is up 60% year on year. So there is very much an almost acceptance that AI will add efficiency, and automation is good for certain markets and will add transparency. There's also the other side of the coin, though, with AI. I love talking about AI, as you can tell. There's also the other side of the coin that allows you to do things much more efficiently. So it's more the cost side as opposed to the revenue side. I just talked about the revenue. This is more the cost, where the humans are able to traverse, make sense of the data that they are consuming. And as more and more things go electronic in the world, more and more data gets output. More and more data gets output. A human can't understand every single piece of data. They need help in order to do that.
What does that mean for the future of the floor, which I think is premised on the idea that human intelligence at certain points in the process really does matter?
It absolutely matters. We process 500 billion incoming order messages a day. Buys, sells, whatever the case, trades, whatever the case may be. A human can't do that. What a human can do, though, is notice anomalies in the data. They can toss out anomalies. They can put their market experience, their market intelligence into the equation and not just rely on a machine. And that ultimately smooths out volatility. So in my mind, the most tech-forward organizations are ones that harness the power of technology and data and enable the humans to do more on the intelligence side.
Regulators, I think, have basically said no more exchange M&A. We're done. But there have been some big deals. You've done some of them, mostly to data and software, assuming that you don't want to be just basic infrastructure or utility going forward. Where are you spending your time? Like, what's the next thing for you guys?
Yeah, regulators feels like have made a statement in general about M&A in general, not just specifically with the exchange sector. Our parent company, ICE, just completed our most recent strategic transformation, which is digitizing the mortgage industry.
But I would note too that was a tough antitrust review. It took forever.
It took a long time.
You had to sell a couple of businesses.
It took a long time, and the whole strategic rationale of the deal was to interact with the customer, like we do in our other segments, on an end-to-end basis. So the whole strategic rationale was to add servicing to our mortgage business. We had origination, we had closing, but we didn't have the servicing element. when we interact with our customers, we like to talk to them about their challenges, their business opportunities, their strategy end to end, and not just go in with I'm going to only talk to you about this part of your business. So that was the strategic rationale there. But it's a playbook that we've been running since we formed ICE. How do you digitize markets? How do you take processes and markets that are analog and convert them into digital? How do you harness the power of technology, to go back to something I said earlier, to make humans more productive and to make processes and markets more transparent? And it's just the same playbook that we've done first with the energy markets, then the commodities markets, then with the fixed income markets, now we're doing it with the mortgage market.
Have we hit peak alternative data? I mean, I feel like the days when it was, I remember covering this, in the early 2010s, and the idea that you could have a drone that would count all the cars in the Walmart and would somehow predict Walmart's earnings. And that was cutting edge, and then it became, cargo ships, and it sort of moved further and further. I don't know, is AI gonna unleash just brand new kinds of data that you can't even imagine? Or I don't know, we had a story earlier this year that actually the data set that is most in demand right now is just 40 years of bond prices, right? I don't know.
We have a solution for that.
I'll send them your way. What do you make of that sort of that arms race for?
So it's also, I equate that to what happens in markets that get digitized. Data is an incredibly important input to AI, because if you're feeding your AI with bad data, you're going to get a bad result. But then data is also an incredibly important output of AI. It's the same thing with any digital marketplace, anything that's technology driven. Data is an important input, data is an incredibly important output. So I think you probably will continue to see the amount of data increase in this world. I mean, you think about all of the data that gets looked at today. It's not just the imagery from the parking lots. It's data around weather patterns and how those affect markets, climate change, things of that nature.
So you think that edge, people still
Absolutely, absolutely. Because if you think about even just climate in general, think about the commodity markets. There's a direct correlation, the energy markets, there's a direct correlation between commodity prices and weather-based events, be it cold winters or hot summers or catastrophic events like hurricanes and wildfires. That has an effect on markets. So that ultimately is now data that's able to be harnessed and in real time as opposed to survey-based, and is able to be leveraged to manage risk.
All right. Thank you so much for coming.
Thank you.